For the past 15 years, we see that US stocks have severely outperformed international stocks by quite a bit. However, we see that in the past 50 years, that has come in cycles. We see that in the 70s, international stocks have outperformed due to the energy crisis and high inflation. We see that in the late 80s and early 90s, international outperformed US. We see that after the dot-com bubble bust from the early 2000s up until the great financial crisis, international also outperformed US. Now, what we do see here is a very long stretch of US outperforming international stocks. The question is, are we seeing a tapering of that? And are international stocks soon going to be the way to go? And indeed, we see that in the index funds. We see that in the ETFs. We have VU, which is the Vanguard S&P 500 ETF. We see that if you had invested VU 10 years ago, you will have gone up 300%. That is a 4x on your money. So if you had invested $10,000 10 years ago, that's now $40,000. VXUS is every single international stock that's not in the United States. You will have gone up 130% in that time, and VWO coming in at 125%. VWO is the Vanguard Emerging Market Fund. So those are smaller countries. Those are countries with lower GDP that are emerging and getting onto the main stage in the market. So indeed, in the past 10 years, the clear choice was the S&P 500. If we look at the past 5 years, again, VU, S&P 500 is the winner, doubling the performance of VXUS. But we look in the past year, and that starts to change. We see that VU is in third place among these three. We see that VXUS, had you invested into international stocks 1 year ago, you were up 34% compared to VU's 18%. Now, 18% beats the market average of 10%, but the VXUS and the emerging markets VWO far outpace that by quite a bit. So the question is, are we starting to see a shift in international funds? Are we starting to see international stocks taking dominance over US stocks, or is there a case to be made for US stocks still? Well, we focus primarily on United States stocks on this channel. However, in this video, we're going to take a break and we're going to look at some international companies on our radar that have low debt, they have a lot of growth, even some safety baked into it. So all I ask for in exchange is that you like this video if you get anything out of it, subscribe to the channel, tell your friends, your family, your mother-in-law about this channel. We are growing the Interflame Finance family, and we look forward to serving you in the years to come. Now, your time is valuable. I don't want to waste it. So what I've done is I've used a FinViz stock screener, and I've eliminated all the garbage companies, all the ones that don't meet our very specific criteria for this channel. If you want to see how to use the stock screener, I've linked a video in the description to this video showing you how I like to use stock screeners to find quality companies, so I'm not wasting a bunch of time looking at garbage. Also, I've eliminated any companies that don't have good scores in our scoring method here at Interflame Finance, and I've also eliminated companies that don't have decent intrinsic value. So your time is important. We're going to look at only the quality companies. So the first company that we're going to look at is DHT. DHT is an oil tanker company. They have a PEG ratio of 0.4. Remember, we want PEG ratios to be under 2 to even give it any sort of consideration. And we want it to be under 1 to be a fantastic company, fantastic growth opportunity. And they are coming in at a quality 0.4. Forward PE coming in at 7.8. 5-year forward PE coming in at 4.3. Healthy profit margins at 39.2%. Second, we have DRD. They are a gold mining company. They have an even better PEG ratio at 0.2. They have very little debt to equity, return on invested capital of about 24%, expected EPS growth of 41%, and a 5-year forward PE at 3.8. That means that if you buy DRD today, you are getting it at a 3.8 PE ratio, price to earnings ratio, within 5 years. That is just phenomenal. Third on the list, we have KSPI. This is a fintech company in Ukraine, Azerbaijan, and Kazakhstan. They have a forward PE of 6.1 and a 5-year forward PE also at 3.8. Free cash flow yield at 23%. Return on invested capital, a phenomenal 54%. And even better than that, return on equity at 60.6%. Fourth on the list is Oddity, ODD. This is a company that uses AI to market beauty products across the world. They have revenue growth coming in at 19.9%, which is phenomenal. 5-year forward PE at 8.9, pretty decent. PEG ratio just under 1, so certainly within the realm of a cheap bargain for something relative to its growth, which, by the way, its revenue growth coming at 19.9 and also its EPS growth coming in at 19.9%. Fifth on this list is OPRA. OPRA is a browser starting to get into the AI space with an AI browser. DE, debt to equity, basically nothing, 0.0. Forward PE of 11.4, 5-year forward PE at 7.5. Fantastic for a tech company, a software company like this, and pretty decent numbers all the way around. PEG ratio coming in at 0.7. Number 6 on this list is RLX, Relax. This is a tobacco company, an e-vape company based out of China. Some people don't want to invest in such companies. If you don't, that's fine. That's your choice. That's the beautiful thing about investing in the market is you get to vote with your dollar and put your money where you choose to put it. RLX is in the tobacco and nicotine space, and so that may not be something that you want to have in your portfolio. They are looking at 39.9% EPS growth every single year for the next 5 years. PEG ratio coming in at 0.4 and no debt to equity. Of all the plays, I will say right off the bat, this is the riskiest play. They are like a $2.33 company, something like that. There's a lot of room for growth, but there's a lot of risk baked into this company as well. Number 7 on this list is Ryanair. Ryanair is an airline company, and a lot of people don't like to hold airline companies. There's a lot of risk. There's a lot of downsides. It's very expensive to run an airline company. However, this did come up on our list. PEG ratio of 0.6, forward PE of 13, 5-year forward PE coming in at 0.6 if they can execute on 18.8% EPS growth. Sanofi, ticker SNY, is a drug maker. Really, the main standout number here is the 9.3% free cash flow yield. Everything else looks fantastic for this company. PEG ratio at 0.8, forward PE at 9.9, 5-year forward PE coming in at 6.1, return on equity and return on invested capital, not too fantastic, kind of in the middle of what we're seeing for the other companies. And the last company we have here is Taiwan Semiconductor, and we all know and love TSM. They have return on equity of 34.8%, profit margins of 44%, revenue growth coming in at 18% expected, 24% expected earnings per share growth with a 5-year forward PE of 11. That is a screaming steal deal for such a high quality tech company. So if you're new to this channel, what we do is we score companies between -10 and +10. -10 is an absolute garbage company. We throw it away. +10 is the best company in the world. 0 is neutral. We like to be picky and choosy with our picks, and so we typically choose companies that have scores of 5 or higher. Now, what we also do is we break this down between growth and safety. So far, we have focused on the growth metrics, such as the PEG, the forward PE, return on invested capital, and profit margins, etc. So, going from bottom to top, the first one is OPRA coming in at a very healthy 5.6. Relax is coming in at 6.1. SNY, the drug manufacturer, coming in at 7.8. We have Oddity coming in at 7.8. We have TSM coming in at a very strong 8.3. DRD, the gold mining company, comes in at an 8.3. KSPI coming in at 8.9. The airline company coming in at a very strong 9.4, and DHT, the oil tanker company, coming in also at a 9.4. If you look at the sectors that these companies are in, we see a lot of diversity. We see communication services, consumer staples, healthcare, technology. So if you wanted a decent amount of diversification in the international space, given these very strong numbers in the growth area, these would all be fantastic plays to consider for your portfolio. While we're on that topic, please remember that nothing that we say on this channel is financial advice. We are not telling you to buy, sell, or hold anything in your portfolio. Always do your own research and due diligence. This video is made for entertainment and informational purposes only. Now, we're also going to look at safety scores, and the main driver of safety is dividend growth and dividend yield. And there are some very similar metrics here, like 5-year forward PE. There is a PE ratio, not the forward PE ratio, but just the PE ratio, meaning what are they currently doing? And we also want to focus on debt to equity. That is important for the short term and for the long term. So DHT is coming in with a PE ratio of fantastic 9.5 right now. Dividend yield at a solid 8.2%. However, they have cut their dividends recently, so we don't like to see that. 5-year forward PE coming in at a 4.3. DRD, the gold mining company, has very little debt to equity. They are in the low 20s with PE. However, their 5-year forward PE is coming in at a 3.8. Return on assets, fantastic, 18.5%. Dividend growth, a very solid 86.4%. Their dividend yield is on the medium side of 1.3%, and they have grown that dividend 1 year in a row. And their current payout ratio is 21.3%. We like to see it in that range. KSPI, very solid PE at 7.2, return on invested capital 54.1. They've grown their dividend for 2 years. However, we could not find reliable information on their dividend yield or their dividend growth, but we did find that on average, it looked like that they have grown their dividend for 2 years. Oddity is coming in, no dividend to speak of, so they probably will come in lower on the safety range. And nothing really to speak of when compared to their counterparts. PE at 22, debt to equity, it is solid at 0.8, but there are better companies that we are looking at today for safety. Return on invested capital and return on assets, pretty decent as well. OPRA has very little debt to equity to speak of. They do have a dividend yield of 5.6%. They have not grown them at all. And their payout ratio looks kind of high at 86.3, so that will give us some reasons for concern. RYAAY also pays a very, very small dividend. It's 2.6%, but it's a very small cap company, and it's only like $2.33 per share right now. And so the dividend is just a couple cents. Payout ratio coming in at 11.3%, so that gives them room for maintaining or even growing that dividend. We have the airline company, Ryanair. Pretty decent numbers across the board, but when compared to their counterparts in this video, nothing really to speak of. But they do have a 5-year forward PE coming in at 6. They do offer a dividend at 1.3%, and they have grown that dividend 9.6%. SNY, they've grown their dividends for 2 years in a row now. Their dividend yield is a solid 4.2%. With a payout ratio of 42.5%, there is reason to believe that they can maintain those dividends. Return on invested capital, 8.1%, and return on assets, 4.7%. And finally, Taiwan Semiconductor, return on assets, a fantastic 19.9%. They do pay a dividend, very small at 0.9. With a tech company like TSM, you do want them to invest more into research and development. And so if they offer any dividend, you want that to be low so they can use more profit for building out their business. They have grown their dividend 32.7% this year, and a dividend 3 years of dividend growth in a row. So that's fantastic for Taiwan Semiconductors. When it comes to their scoring, RYAAY comes in at the least safe company, and that's no surprise. They pay no dividend, and they are a very high risk company in the tobacco space. We have Oddity coming in at a 5, also not a dividend payer, so that's no surprise. DRD, the gold mining company, very small dividend at 1.3%, so they're coming in with a 5.7. TSM, as far as safety is concerned, is a 6.4. These are all numbers, well, except for RYAAY coming in over 5, so that's what we like to see. OPRA coming in at a 7.1 for safety. SNY, the healthcare company, the drug manufacturer coming in at 7.9. The airline company coming in also at 7.9. KSPI coming in at also 7.9. And finally, the oil tanker company, International Oil Tanker, coming in at a very solid 9.3 when it comes to safety. So that's how these numbers stack up with our scoring method. So what we're going to do now is we're going to look at the intrinsic value of these companies. Down in the description of this video, I have linked 4 different videos for computing intrinsic value. Intrinsic value is one of the most important things you can do as an investor. As Warren Buffett said, price is what you pay, value is what you get. We want to make sure that these companies that we're buying are at a good value, that the market determines what the price is. The market tells us what we're going to buy and sell these stocks for, but value is what we think the company is actually worth. We have 4 different ways of doing that now on this channel. So all 4 of these methods are linked up in the description of this video. Please check it out. Build out these spreadsheets for yourselves. You can do these for the companies that we're covering today. If you disagree with the numbers that we're using, you can do them yourselves. And if you want to analyze any company that we don't cover, you can do that. So this is teaching you how to fish. This is not giving you fish. This is a very essential, fantastic tool for any investor. The first model is the PE multiples model that we see here. We take projected earnings per share, we send it out in 10 years into the future, we scale it back with a discount rate to look at present value, and we use the PE ratio and the price to earnings, or the earnings per share and the price to earnings to figure out what the intrinsic value is. You can see I've done that here for TSM, assuming 5-year EPS growth of 22%. It comes in at a price of $581 per share. It's currently $319.61. That gives us a margin of safety of 45%. I've also done it with a dividend discount model. Since TSM does pay a dividend, we are using the dividend discount model as well. And so you can see intrinsically, based on their dividend payout, TSM should be trading for 608. They're currently trading for 320. That gives us a 47% margin of safety. We also do a discounted cash flow model. And again, we are assuming that TSM is going to grow 22% per year for the next 5 years. We look at their free cash flow, we look at their cash and cash equivalents, we add it all up, and we find that intrinsically, based on their cash flow, TSM should be trading for 62. They're currently trading for 320. That is not a good margin of safety at all. And then the Peter Lynch model, this is one of the newer ones to this channel, linked in the description below, posted. We see that with 22% growth and a 0.89% yield, given where they're currently at, the PEGI ratio comes in at 1.43. That gives us a Lynch value, intrinsic value of 224. Current price is 320. That's also a 42.8% premium. So what we do is we don't look at any of those in isolation. Obviously, if a company does not pay a dividend, we probably wouldn't use the dividend discount model. We probably wouldn't even use the Peter Lynch PEGI ratio model. So we would use the other two. But what we would do is we would average whatever valid models we had together, and that would give us a pretty good idea of what the intrinsic value of these companies might be. Now, I have gone ahead and done this for every single company, but for TSM, we see the PE model came in at 582, the dividend discount model came in at 608, discounted cash flow at 62, the Peter Lynch model came in at 224. If we average those four together, all four are valid, we get an intrinsic value of 369. Now it's currently trading for 320. So for TSM, that gives us a margin of safety of 13.4%. And please recall that the way that we like to do things on this channel, we like to bake in caution, and we like to be conservative with our money. So there are various things that we've implemented in these intrinsic value calculations to make sure that we are very cautious. And so if we want at least a 10% margin of safety, we would call TSM a buy. So what we're going to do is we're going to do this for all 9 companies. We're going to filter out any models, any intrinsic values that don't make sense, like a dividend discount model for a company that does not pay out a dividend. And we're going to see what the intrinsic value of these companies might be. So the first company that we have is RLX. They have the lowest average score, growth of 6.1, but a safety of 3.6. Now, like I said earlier, this is the riskiest play. This has the highest risk reward profile though. Possibly a lot of reward, 6.7, margin of safety. However, there's a lot of downside potential as well. So this is something to use extreme caution when buying. But when you look at their debt, when you look at their potential growth, this looks like something that if you wanted to throw a couple bucks in just to scratch that gambler's itch, this might be the play for you. If we look at what they are expected to do based on analysts, well, there's only one analyst covering the stock. Okay. And they're saying that the average and median score $2.25. They're currently 232. So there is a little bit of downside. So please use extreme caution when buying any company in general, but especially something of this nature. Now, in the past year, they've grown 7.41%. Past 5 years, they've just plummeted 81%. So this is a high risk play. It's not coming in with any sort of realistic amount of safety in this company. So please use extreme caution when buying it. Now, OPRA coming in with an average score of 6.35, they have a margin of safety of 35.3%. And if we look at OPRA, we see that over the past year, they have gone down about 25%. It looks like they're maybe bottoming out now, so maybe this is time to execute on OPRA. When we look at what analysts are expecting, analysts all across the board, even the lowest analysts, say that this is a buy. As a matter of fact, we look at the analyst recommendations, that's coming in at a strong buy. Now, there are only 3 analysts that cover this, so keep that in mind. Nobody's saying hold, nobody's saying sell, nobody's saying strong sell. There are 2 analysts saying strong buy and 1 analyst saying buy. So an average return of 23.83%. For OPRA, we said $22. So we are on the low end, but we still see that potential high growth for OPRA. Oddity coming in third with a 6.4, margin of safety of 22.6%. Their intrinsic value, according to our calculations, is a 51, currently trading for $39 per share. Past year for Oddity, we see that they are basically down 6%. They had a big bull run in the middle of last year. They went up to $77, but then they came crashing down. Analysts' expectations, if you look on stockanalysis.com, analysts suspect that this stock is going to grow on average between 76 to 97% in the next year, with the high estimate coming in at $90 per share. That is a more than doubling of your money at 128%. The Wall Street consensus says buy. 4 analysts are saying buy, 4 are saying strong buy, 3 are saying hold. Nobody's saying to sell this stock. This might be something for your portfolio. Again, probably a lot of risk baked into this company, something to consider. Their numbers and our. Ours for oddity, we are coming in at $51 per share. So we are on the lower end of what Wall Street analysts are expecting, something to keep in mind. DRD coming in at an even 7 for average. Price is currently $30 per share. Intrinsically, we think they are worth 66. Margin of safety of 54.1%. When we look at DRD over the past year, we see that DRD is up 251%. That is a 3.5x on your money. Gold has gone on a massive bull run this past year, this past 2 years, and we see that reflected in a lot of the gold mining companies. When we look at the forecast, well, Wall Street is not as bullish when it comes to their average price target. On average, they're in the high 20s to mid 30s. They're seeing anywhere between a 9% drop to a 20% gain. However, of the only two analysts that cover this, both are saying strong buy. So it's a strong buy. Only two analysts are covering it, though. One is saying that it's down here at $18.75. So do with that information what you will. We think the DRD is a $66 company that is way, way, way past these expectations. So what do you think? Are these numbers off? Do you think that we are assuming way too much growth for this company? Are we too bullish, or do you actually see value in DRD? The next company is Taiwan Semiconductors at a 7.35 score. They're currently trading for $3.20. We at Interflame think that this company is worth $369. That's a margin of safety of 13.4%. Forecast for Wall Street, they see between a 12 and 13% upside. The highest analyst is saying 25% increase, a target price of $400 per share. Nobody's saying to buy, or rather to hold or sell. The analyst consensus is a strong buy. 3 people saying buy, 1 people saying strong buy for Taiwan Semiconductors. Next on this list is SNY, the drug maker, currently trading for $48 per share, intrinsically 102 based on our estimates and calculations, with a very solid average score with both decent growth and decent safety, coming in at a 7.85. We see a 52.7% margin of safety for this stock. And if we look at Sanofi over the past year, we see that they haven't really done much. They've gone up, they've gone down. Maybe they're bottoming out here. We're not too terribly certain about that in terms of what the future has in store, but we do feel like they've bottomed and that there's some room for growth. Forecast for this company, we see that of the 2 analysts that cover this, the high is 65, the low is 58, both coming in well over their current price of $48 per share. The average on Wall Street is $61.50. The overall consensus is buy. 1 person saying buy, 3 analysts saying hold last time. And we do see that in this bar chart down here. Now we are saying SNY is coming in at 102, so we are especially bullish on this channel based on the numbers, based on what we're seeing. $102 per share, way, way, way beating out the high expectation of $65 per share. Let us know what you think. Next, coming in at a very, very respectable average score of 8.4 due to their strong growth and strong safety is KSPI, the fintech company. We see that they are currently trading for $78 per share, intrinsically 170. That gives us a margin of safety of 54%. Now, if you look at this company over the past year, they are beaten down 18%. We look at the past 5 years, they are very similar kind of story. They haven't really done much. As a matter of fact, they're down 16% in the past 5 years. The forecasts from Wall Street, there are 2 analysts that cover this. The low estimate is $96 per share. That is growth from their current price of $77.54. The high expectation coming in at 130. Again, we are saying 170. Based on the growth that we see, based on our expectations, we think that KSPI is especially a fantastic, attractive looking stock. Now, average Wall Street analyst is saying 113. That would give us an upside of between 45 and 68%. So KSPI, possible good buy. We diverge very much from Wall Street here. We are especially bullish on the stock price in the near term. So let us know what you think. Now, the second to last stock is RYAAY. We see that they have a very, very healthy average score of 8.65, 9.4 for growth, 7.9 for safety, intrinsically $75 per share. They're currently trading for 73. That is very close to what they're currently trading at, their fair price. So that only gives us a margin of safety of 3.3%. If we look at what they've done over the past year, we see that they have exploded 66% in the past year. That is just phenomenal. We look at analyst forecast. There's only 1 analyst covering it. They don't see much upside either. They think that RYAAY has done all their growing like we believe on this channel. Their current target price is $76 per share. We are saying $75 per share. That does not give us much upside for the next year. And finally, DHT. The average score for this oil tanker company is 9.35. Their growth is 9.4. Their safety is 9.3. You cannot deny that these numbers that we saw earlier are fantastic. Currently trading for $12 per share, intrinsically $33 per share. That gives us a phenomenal margin of safety of 64.4%. When we look at this company, we see that in the past year they have grown 26%, beating the S&P 500 and being very much in line with other international stocks. The forecast for this company, everybody seems to be bullish on this company. There are 3 analysts that cover this, and the consensus is that this stock is going to be $15.67 in a year from now. It's currently trading for $11.74, so that gives us an increase in the mid 30s. And we on this channel think that this is actually a $33 stock. And so again, we are especially bullish on this, given their fantastic growth, their fantastic numbers, their profit margins, low debt to equity. This is a phenomenal company, something to consider for your portfolio as well. We will certainly be thinking on this in the coming weeks for the Interflame Finance portfolio. And so, with that being said, we see that on the right-hand side, this is what we would invest in the Interflame Finance portfolio, given their scores and their margins of safety. So these numbers are all based on weighted averages of those scores, of their average score and their margin of safety. And we see that something like RYAAY that has a fantastic score but very little margin of safety, we would only invest $1 out of $100 into this company. And again, this doesn't have to be $100. You can think of this as 100%, and all these values are percentages. So 12% would go into RLX, 8% would go into OPRA, whatever you invest into the market. This is what the rationale would be. Okay. Now, again, nothing that we say on this channel is financial advice. I'm not a professional financial advisor or planner, so always do your own research, run your own numbers. You can do that with the intrinsic value calculators that are linked in the description of this video. But the thing is these 9 companies offer a wide range of diversity in the international market. They all have great scores. They all have fantastic margins of safety. Some come with considerable risk, I will admit that, but these are fantastic companies to get into many different sectors in international stocks if your thesis is that international stocks will start to outperform domestic United States stocks. Now, typically on this channel, what we do is we only look at companies with margins of safety of 20% or higher. And we do see a couple sneaking in below that. So TSM is coming in at 13.4%, RYAAY is coming in at 3.3%. And so this gives you an opportunity to maybe buy quality companies like Taiwan Semiconductors at a 13.4% margin of safety. You're only investing $4 into that. But if you are starting out, if you're building out an international stock portfolio, the idea would be to invest in all 9 of these. Now, if you want to stick to that algorithm, that methodology of only investing in things at a 20% margin of safety or higher, what you would do is you would take out the gold, no, not the gold mining company. You would take out Taiwan Semiconductors like this. You would take out RYAAY like this. And so now you're only investing into 7 companies that all have margins of safety 20% or higher, and they're all coming in at average scores above 5, except for Relax. And again, that is a tobacco company. They deal in e-vape products, and so that might not be something that you want to have in your portfolio. And so if that were the case, you would remove this one as well, and you would invest in these 6 companies as instead. So OPRA, 10%, Oddity, 7%, DRD, the gold mining company, 17%, the drug manufacturer, 19%, KSPI 21%, and finally DHT, the oil tanker company, at 27%. So let us know in the comments what you think. What are you buying? What are you selling? Do you think international stocks are going to outperform United States stocks in the near future, or do you think the United States is still going to be the dominant player in the next 5 to 10 years? So we hope that your 2026 is off to a great start. Please consider liking and subscribing. Thank you very much for your time. Have a good rest of your day.